With a net worth of more than $82 billion, Warren Buffett is one of the most successful investors of all time. His investing style, which is based on discipline, value, and patience, has yielded results that have consistently outperformed the market for decades. Buffett stated in 2016 that when trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap the outsized profit. Both large and small investors should stick with low-cost index funds. Alright guys, so index funds are hugely popular with investors because they ensure possession of a wide variety of stocks and generally have a lower risk. This is why many investors, especially those who are just starting out, find index funds to be better investments than individual stocks. So here's the deal guys, rather than trying to beat the market, many people choose to beat the market by investing in passively managed funds. Now over the long term, passive investment vehicles like exchange traded funds or ETFs and index funds have consistently outperformed the vast majority of active funds, making them great choices for most investors. Alright, so you might be thinking about what an index fund actually is. Well, you're going to find out in this video. Hey Joe Dolls, welcome back to my YouTube channel, and today I'm going to be discussing what are index funds and ETFs. Be sure to stick around to the end of the video about some of the best ETFs in the market right now. But before we start, if you're new here, make sure you subscribe to the channel and don't forget to hit the notification bell so you never miss any updates. Alright, so without further ado, let's begin. First of all, I want to tell you what an index fund actually is. So an index fund is a mutual fund that matches or tracks a specific market index. So here's the thing guys, you can build a diverse portfolio of earnings, consistent solid return using mostly this type of investment, and that's because index funds are not designed to try to compete with the market. Instead, these type of funds aim to become the very market by buying stocks on every firm listed on an index to mirror the performance of the index as a whole. So index funds can help assess the risk in the investor's portfolio since market fluctuations tend to be less resilient across an index when compared to individual stocks. Alright, so now let's talk about ETFs. An exchange traded fund or ETF is a fund that can be exchanged on a trade similar to a stock, meaning it can be bought and sold all the time. Now ETFs often have lower costs than other types of funds. Matter of fact, they have varying levels of risk depending on their type. So basically an ETF works like this. The fund provider keeps the underlying assets, creates a fund in order to track the performance, and then sells those shares in that fund to individual investors. Now you as a shareholder can own a portion of an ETF but cannot own the underlying assets in the fund. But regardless, investors that track a stock index may get lump dividend payments for the stocks that make up the index. Now I'll tell you about my 5 recommendations for ETFs and index funds that you should consider investing in. By the way, these are in no particular order. Alright, so the first one is Vanguard Total Stock Market ETF, ticker VTI. So the Vanguard Total World Stock ETF is a very reliable choice, especially for investors experiencing ticker overload. It is undervalued versus the US stock market by a notable margin and has many diversification benefits. The Vanguard Total Market ETF is a well-diversified exchange-traded fund that holds over 3,900 stocks. The ETF's top sector is technology with a 27.7% weighting, while Microsoft, Apple, and Alphabet are its top 3 holdings, making up 13.2% of the ETF. Now, as far as costs are concerned, Vanguard makes its name by having some of the lowest fees in the industry, and that is made greatly clear with the company's fee structure. Matter of fact, this fund has a low expense ratio of 0.03% and tracks the broader stock market very closely. So this fund makes it a very low cost way to get exposure to the US equity market. VTI has a 1-year return of 38.98% with a 5-year return of 17.39%. This ETF appears to be a solid security to hold in a growth portfolio since it reflects the larger universe of US equities and a low-cost single fund. The next ticker is Vanguard S&P 500 ETF, also known as VOO. So the Vanguard S&P 500 Index Fund is one of the largest in the United States by market capitalization, trading on the New York Stock Exchange and NASDAQ. Matter of fact, VOO is one of the most affordable ETFs with an expense ratio of 0.03%. It trades over 3 million shares a day and can be obtained from any major broker. VOO currently has over $100 billion worth of assets under management. So the Vanguard S&P 500 ETF, or VOO, tracks the S&P 500 index by investing in all of the stocks within the S&P 500. So I personally think it's very appealing for many investors since it's well diversified and comprised of equities of US large corporations. So the fund has very low fees since the fund's management team is not actively trading by buying and selling the stock. Investing in the Vanguard S&P 500 ETF is a solid passive income strategy in which the fund tracks the performance of the S&P 500. It's a very low-stress way for investors to access the U.S. equity market. It has followed the S&P 500 almost exactly since its creation. In 2010, it's given a 18.23% return and 34.5% year return. All right, the next fund is the Fidelity Zero Large Cap Index, FNILX. So the Fidelity Zero Large Cap Index fund is responsible for tracking the Fidelity US Large Cap Index. So this index is a low float adjusted market index, meaning it tracks companies on the basis of the number and value of shares outstanding in the market. This fund focuses on the US large capitalization equity market. So again, it's tracking the 500 most profitable companies. However, it can have fewer companies based on liquidity and vesting screens that Fidelity uses. For example, the index excludes companies with assets worth under 75 million or with limited trading volume. Now, in terms of performance, this fund has returned 36.81% over the past year. So the next fund is the Vanguard Mega Cap ETF, MGC. So the Vanguard Mega Cap Index provides a portfolio of the largest companies in the US equity market. The fund tracks the CRSP US Mega Cap Index, which intends to acquire approximately 70% of the investable US equity market. It seeks a very large growth strategy. Additionally, the fund must pass CRSP's criteria for investment, which requires a minimum of 15 million interest rate limit and 12.5% public float. However, these criteria are relaxed of existing members to migrate turnover. The index picks up the best 70%. And during further reviews, CRSP keeps securities in the index as long as they stay within the 64 to 76% range. All right, in terms of performance, it has delivered 19.14% year to date and a 3-year average of 26.12%. Now, the next fund is the iShares National Muni Bond ETF. MUB is a great option for a low-cost start in the investment market, and if you want to make a more conservative approach to your investing. So the interest of the underlying index municipal bond is exempt for federal income taxes, and it is responsible for tracking the S&P National AMT Free Municipal Bond Index. So you may be wondering why MUB? Well, first off, you get exposure to a broad range of U.S. municipal bonds, access to 2,000 plus municipal bonds in a single fund, and you can use it to seek tax-exempt income. Now, it includes investment-grade municipal bonds with at least a month until maturity and 25 million in nominal value. Overall, it's definitely an excellent investment. All right, so in the end, guys, the choice of the ETF versus index fund is probably less important than the fact that you decided to invest for your long-term goals using a passive investment vehicle. So whether you choose an index ETF or index mutual fund, you'll benefit from lower fees, diversification, and historically superior performance of index-based investing. So what are your thoughts about index funds and ETFs? I would love your feedback and any suggestions on other funds that are good long-term investment. If you found value in the video, do me a favor and tap the like button and share it. It really helps to support and grow the channel. Don't forget to subscribe and turn on the notification bell as I'm posting valuable new updates multiple times a week. Thanks again for watching, and until next time.